Actually, the time that you should be most fearful is when everything is doing really, really well, generally speaking, right? And the time that you should be the greediest, and this is one of Warren Buffett's, most famous quotes, be fearful when others are greedy, be greedy when others are fearful. I just see us starting to slip down that curve a little bit. It's not a lot, but I've definitely had a few conversations, a couple emails. I send out newsletters and I get responses to the newsletters that we send out. And, hey, what do you think about the market? What do you think the market's doing? Is now a good time to sell? Now, should I be taking profits? Should I be, just kind of asking for advice? And the answer is always the same. The answer is, well, let's review your plan. Mm-hmm. And if your plan calls for X amount of money invested in long-term growth assets, we don't change the plan.
I love to use this analogy. This is a common one in our business. I've heard you use this one a lot, and I like the way you use it. It's the mountain climber with a yo-yo. Mm-hmm. If you are standing back 20 miles away from the mountain, you can't see the mountain climber, much less the yo-yo. What you see is that upward trend of the mountain. You know that over time, it's always going to get higher, right? Up to that whatever point. If you close in a little bit and you look at the mountain climber, he's going up and down. Now, he's going up a lot more than he's going down, but there's still rocks he's got to climb over and, crevasses or whatever in the mountain that he's got to deal with. There's a lot of ups and downs. If you get up really close and you only watch the yo-yo, you are going to have a bad case of motion sickness. And I think that's what people do when they get emotional. The comment that I have, the moral to this story is stop watching the news. Just don't watch the news. If you're a long-term investor, which is what most people should be, you shouldn't be looking at the yo-yo. There shouldn't be any emotion to it. And that's easier said than done, I know. But if you're looking at that yo-yo, you're going to be panicking, right? That's one of our steps in here is panic, right? Yep. Stop looking at the yo-yo. Stop looking at the mountain climber for the most part and step back and look at the mountain.
All right, welcome back to another edition of the Retirement Planning Happy Hour. Eric Douglas, Chris Vaughn with Family Wealth Planning Partners. This is the YouTube series podcast where we talk about all things finances and investments and, of course, retirement planning while we enjoy a nice pour of a pretty good bottle of bourbon. We have a really good one today, I believe, that Chris has brought with us that he's had before. This is my first time tasting this one, so it'll be a good one for me. Topic for today, we're going to talk about emotions in the stock market again. We've talked about it. It's been a little while. We want to revisit it today because apparently the sky is falling again this week. Our pets' heads are falling off. The world is ending. It's amazing because we've had just a tiny bit of volatility in the S&P 500 right. and in the NASDAQ more specifically. Yes. But we had a little bit of volatility in the stock market, and you would just think that everything is just,
Chicken Little.
Everybody's got to get out, right? And it's just interesting how quickly people that never pay attention to the stock market and they have no idea what's going on, all of a sudden when we get just a little bit of volatility, suddenly are in tune to everything that's going on. And so I think just based on some discussions that we've had, some questions that we've gotten this week, it was important to revisit the emotional side of investments specifically. We're not going to prognosticate on market predictions. That's not what we do.
There's no crystal ball here.
There's no crystal ball here. I know there's a lot of people that make a lot of money telling people what they think is going to happen in the market, and guess what? They're all wrong. Or they're right sometimes, but broken clock is right twice a day, right?
Ooh, I like that one.
Yeah, nobody knows. The bottom line is nobody knows what's going to happen. We can guess and we can make predictions. At the end of the day, we keep our focus where it needs to be as when it comes to retirement planning, specifically as it relates to the stock market, and we keep a very long-term view of the stock market and investments specifically. We talk about investing. We don't talk about trading or trying to time the market. That is our philosophy. It is a philosophy that has worked for generations and will continue to work, I would imagine, for the next several generations to come. So with that being said, that's the topic for today. Why don't you introduce the bourbon for us?
All right, so our bourbon for today is Old Forester 1924. This is the fifth incarnation of the Whiskey Rose series, which we've done on a previous version of our podcast.
We did the other four.
We did the other four along with the unofficial fifth that has nothing to do with the Whiskey Rose series. That's the Statesman. It has nothing to do with it, but they always seem to be, displayed together for some reason. So the previous four, they're based on the year that this recipe or variation on it originally came out. So it's the 1870. That's the original OFO. It's fantastic. It's sweet. It's got lots of corn, and it's one of your favorites that you talk about all the time. Then they did the 1897. If you're a history junkie, you know that's the year that the Bottled in Bond Act passed. That was the very first food safety law in the United States. And, the big one that everybody remembers on Bottled in Bond, it's 100 proof. There's more to it, but that's the big one. Then in 1910, they had the big fire downtown at the distillery. A lot of brand new barrels that had not been filled yet got overcharred. They decided to use them anyway, and they basically inadvertently created a double oak. So the 1910 is their version on a double oak. And then the 1920, so Prohibition is kicked in at this point in time. And Old Forester was one of the distilleries out there. There were not that many that got a permit from the federal government to produce medicinal bourbon. I want to put air quotes on the word medicinal. It was just a way to subvert the law. That's really what it comes down to. Entrepreneurs always will find a way.
The good ones, yep.
To make money when the government changes the rules. It never ceases to amaze me how people don't get that. They will find a way to legally make money because that's what's in their best interest. So anyway, that's the 1920. Now the 1924 is based upon this. This, unlike the other four, is a limited release each year. The rest of them are available year-round. This started in 2024 on the 100th anniversary, hence the name. This is the 2025 version. But basically, Old Forester, like I said, was one of the handful of distilleries that had a permit to make medicinal whiskey. A lot of other companies were literally going out of business, but they produced all this, what we call juice. They had bourbon out there that they couldn't sell. So a lot of them got together with Old Forester and said, here, buy our stuff from us. They did buy quite a bit of it. They blended it together and released another medicinal whiskey that originally it was not Olfo juice, right? It was somebody else's product all blended together. And this is just a tribute to that time frame. I love it just because it's a tribute to figuring out how to beat the government at their own game. And that's why I love this one, because the story behind it's great.
I will certainly drink to that.
We'll drink to that one.
I will certainly drink to taking your medicine as well, right? That's that's certainly as good a reason as any to take a little sip of bourbon here. So we'll come back and give our thoughts here towards the end. So with that being said, I want to come back to this emotional mindset around investments specifically, and kind of the emotional cycle of investing, because we're definitely getting to a point where we've passed the state of euphoria. I would imagine that was probably occurring maybe a month ago.
Beginning of October, sure.
Yeah, maybe a month ago,
Pretty
where
high.
it was just, everything was fantastic. The market was never going to go down. It's been up, and this is a fun little ride. The tariffs. Nobody remembered what a tariff was.
We'd completely forgotten about that.
Completely forgot what a tariff was, and how scary that was at the beginning of the year, even though we're only going back 6 months. So the market's been on a pretty good 6-month tear, give or take. Which, fantastic. Love it. And, we'll love it for our clients, of course. But it's interesting when you start thinking about the emotional cycle of investing, and we'll show this chart up on the screen here as well. But you kind of get to this part where you get to, the thrill of investing, the euphoria of investing, where everything is great. And what's amazing to me is how quickly you go from that euphoric feeling to starting to drop off and getting really, really scared. And it doesn't take much.
20 minutes.
Yeah, and the S&P 500, and we just checked before we started recording this week, the S&P is down about 0.5%, 0.5%. Now it's been a little bit of a rocky road this week specifically, but overall we had a really, really bad day in the markets yesterday. But the market's off about 0.5%. The Nasdaq is down about 1.5%.
Yeah.
The Nasdaq is obviously far more tech heavy. It's always has been far more volatile anyway than the S&P 500. The Dow Jones Industrial Average is actually up. It's actually positive just a little bit for the week. So, as much as people might think that the sky is falling because they're seeing some of the biggest names in the country or some of the biggest companies, that, some of those stocks are having some volatility right now. The world is not coming to an end. The stock market is still continuing to go on. So it's important to keep that in mind, because I feel like we've passed that euphoric feeling and we're fresh into anxiety now.
Right.
And, when you kind of get to that top of the mountain, you start coming down that emotional curve, you start getting into anxiety, you start to getting into fear, right? I don't know necessarily about denial. They have denial on here. I don't ever see denial. I see it goes straight from anxiety to fear. Has been my experience.
All right.
With the clients that we talk about.
So, by the way, you're talking about this chart that we're looking at. If we can throw that up on the screen, where those who are watching can watch it.
Yep, absolutely.
Or can look at it. I'm sorry.
Yeah, absolutely. So this is just once again kind of that we refer back to this chart a lot with clients because it's a really, really good reminder about actually the time that you should be most fearful is when everything is doing really, really well.
Yep.
Generally speaking, right? And the time that you should be the greediest, and this is one of Warren Buffett's, most famous quotes, be fearful when others are greedy, be greedy when others are fearful. I just see us starting to slip down that curve a little bit. It's not a lot, but I've definitely had a few conversations, a couple emails. I send out newsletters and I get responses to the newsletters that we send out. And, hey, what do you think about the market? What do you think the market's doing? Is now a good time to sell? Now, should I be taking profits? Should I be, just kind of asking for advice? And the answer is always the same. The answer is, well, let's review your plan.
Mm-hmm.
And if your plan calls for X amount of money invested in long-term growth assets, we don't change the plan.
Well, I think we're getting a little bit ahead of it.
We are.
One
yes.
of the reasons why you have a plan in the first place is to help alleviate that emotional cycle, right? You've already developed that plan using logic instead of emotion because you're thinking out longer term. So, to kind of the moral of that part is, what should I do? Well, let's go look at the plan. What does the plan dictate, right? Mm-hmm. I find it interesting, you were talking about euphoria is, on this chart, it's listed as the point of maximum financial risk because you're at the top. Well, why would the markets be going down after that, right? Okay, well, let's be real honest. You're at the top. The old commentary about it is buy low, sell high, right? Mm-hmm. Well, you as a retail investor where you're trading thousands or maybe tens of thousands of dollars worth of wealth. It's usually not a lot that people are trading actively. But the big-time money managers, the institutional grade managers, when they're making trades in the millions, tens of millions of dollars at a time. Well, their job is also to make money for their clients. So when the markets are really, really roaring, it does make sense. Remember that whole buy low, sell high. It's high, so they're selling. So when a money manager at an institutional level goes in and sells, $250 million worth of securities over a matter of a few days, now not in their own money, it's institutional level, that is going to cause the value of some of those stocks to drop a little bit, which causes other people.
Well, I was actually going to say, because that's really what it is everybody's a lemming. Okay?
Yeah, absolutely.
Everybody in our business is a lemming. There's very, very few people that actually will put themselves out there and kind of stand on their own convictions. Mm-hmm. Everyone remembers, okay, so The Big Short. The Big Short was the movie that was, made
Which
about...
I did finally get around to watching that movie, and it was outstanding.
I can't believe you've been in this business as long as you have and not seen it. But, so Michael Burry is kind of the main character. He's the Christian Bale character, and he's the guy that was kind of out in front calling for the crash in 2008. Yep. And everyone was calling him crazy, and everyone was calling him nuts. The reason why people still remember him is because he was someone who was a dissenting voice. He was saying something different than the conventional wisdom across the board. And it's interesting because I've seen his name coming back into, coming back into the news a little bit here recently, talking about AI stuff. And we're not going to go there. This isn't necessarily about the prediction markets. But what we're talking about, though, is the fact that he kind of was a sole voice talking about what he thought was going to happen, which went completely against conventional wisdom. Because at the time, going back to the middle of the 2000s, prior to the 2008 crash, we had the dot-com crash, but the 2000s were roaring. The market was doing really, really well. And conventional wisdom was saying, what goes up will continue to keep going up, right? because whatever's happening now is what's always going to happen in perpetuity.
Why is it people continue to believe that over and over and over again?
It's just people get stuck in the moment. It is what it is. But our industry is faced with, there's a lot of lemmings in our industry that, oh, this person's doing this, and oh my God, now I have to follow because this is what everyone else is going to do. So it's not so much the first market maker that you refer to, the first person to maybe sell off. It's when everybody else starts seeing, oh, someone else is starting to sell off. I need to jump on this because I don't want to be left out. Right. And then that's when you start seeing, I don't know a better term to use than lemmings, right?
No, that's good. I like that.
But that's when you start to see people, just copycatting what someone else is already doing. Someone else is already leading the charge. And very, very quickly, with the way that our market system is set up now, it's not like, you go to some old trade desk and you print out a ticker and you hand it over. It's not like it was in the 20s, 30s, 40s, right? These things happen instantly. Everything's done with the click of a button. And so massive amounts of money are moved just at the drop of a dime. And so if one person starts moving money, you can instantly see that somebody else is, and then, nope, I need to take advantage of this, or I need to be ahead of the curve. And so it just causes a domino effect, right? There's a waterfall.
Okay. I love that analogy you're saying, because I just had one pop into my mind. Let's say that what's called a market maker, right? That's what we're talking about. So because it is in their client's best interest to maybe cash in a little bit of the profits, they sell, $10 billion worth of securities, and it causes the next lemming to jump in line. What they're not thinking about is you think $10 billion. Oh my gosh, if he sold $10 billion, he sees something. Yeah, but he's managing $5 trillion. That's a drop in the bucket on the whole thing. They're just doing a little bit of it, but then the lemmings jump in line. And what popped into my head while you were telling that about lemmings, that I think most people can understand. How many times have you been traveling down the interstate, especially at rush hour, and all of a sudden everybody is standing on their brakes and you come to a complete stop? And then you do the stop and go thing, and the guy behind you is tailgating you, and you get frustrated, and people start jumping in and out of lanes, and you finally get through it. And the whole time you're thinking there's an accident, there's something horrible in front of me, and you realize there was nothing there. Yeah. There was nothing there the whole time. It was somebody hit their brakes, right? Maybe they spooked a little bit, maybe they looked down at their phone, whatever. They tapped their brakes. The guy behind them doesn't know how hard they're hitting their brakes. They just see the brake lights go on. So they hit their brakes a little bit harder than the guy in front. And then it dominoes, great phrase, all the way back and makes what was a very simple thing into a much grander problem. And I think that kind of explains what happens when a market maker makes a trade like that. You don't see what started it. You just see the trend line.
Mm-hmm. Yeah, and so many people, once they start to see what they think might be a trend, jump on the trend, even though they might not know why they're jumping on the trend or what created the trend. And I think that's something that's important to remember now, too. I've had this conversation a few times this week. Nothing triggered the sell-off that we've currently had in the market. Nothing. There's been no functional news. It's just more or less, I think people are just enough of the headlines around this AI bubble are starting to penetrate. We've had a really good year in the stock market. We're kind of nearing the end of the year. Maybe people started to take some profits off of the top. But there's functionally been no event or occurrence that has happened to justify the slight sell-off that we've had in the markets from all-time highs over the last couple weeks.
There was a big news thing this week, but it should have made the markets go the opposite direction. And we talked about this. The government shutdown ended.
Oh, yeah.
Right? Mm-hmm. But that, in theory, should have taken the volatility out, because now we know it's not the end is in sight. It's done. So now we just got to clean up the mess from the stupidity in Washington. Right? Did I say that out loud? I did, didn't I?
Oops.
Now we just got to clean up that mess. That, in theory, should put some or remove some fear that's in the markets. And the first day it kind of did, and then we went downhill.
Well, that goes back to buy the rumor, sell the news.
Correct.
Right? You buy the rumor, the anticipation, and then when the event actually happens, that's when you sell, right? Mm-hmm. So I don't know if that's what's happening, and I don't know if that's what any of this is, to be perfectly frank. The point is we don't know.
Well, and that's why we're emotional about it.
Yeah.
Because we don't have any logic to base our decisions on. We tend to be emotional.
Yeah, and when I say we're talking about collective we, because you and I are certainly not emotional about this. No. This certainly not this week.
I didn't sell anything this week, but I think I'm going to be doing some buying.
Yep. So what was interesting too, because I was also talking to someone who made the comment, they were talking about how they had just, added some money over the summer, and now some of that's, starting to go down in value. Well, yeah, because you're looking at it in a very, very short time frame. I added to some of my accounts 3 weeks ago.
Yeah.
I just had some excess cash. I hadn't contributed, in probably 6 months to some of my accounts. And so I made some contributions. I was overdue. Perfect timing, right? But when I step back and remember and keep in mind that I'm not going to touch most of these investments for probably at least 20 years, 25 years, right? Okay, well, then I don't care. I don't care what's happened this week. I don't care what's happened in the last month. I'm not going to care what's happening through the end of the year. I'm not going to care what happens next year. I'm going to care what happens over the next 2-3 decades.
I love to use this analogy. This is a common one in our business. I've heard you use this one a lot, and I like the way you use it. And I've kind of added to it a little bit, put my own spin on it. It's the mountain climber with a yo-yo, right? If you are standing back 20 miles away from the mountain, you can't see the mountain climber, much less the yo-yo. What you see is that upward trend of the mountain. You know that over time, it's always going to get higher, right? Up to that whatever point. If you close in a little bit and you look at the mountain climber, he's going up and down, right? Now, he's going up a lot more than he's going down, but there's still rocks he's got to climb over and, crevasses or whatever in the mountain that he's got to deal with. There's a lot of ups and downs. If you get up really close and you only watch the yo-yo, you are going to have a bad case of motion sickness, right? And I think that's what people do when they get emotional. The comment that I have, the moral to this story is stop watching the news. Just don't watch the news. If you're a long-term investor, which is what most people should be, you shouldn't be looking at the yo-yo. There shouldn't be any emotion to it, and that's easier said than done, I know. But if you're looking at that yo-yo, you're going to be panicking, right? That's one of our steps in here is panic, right? Yep. Stop looking at the yo-yo. Stop looking at the mountain climber for the most part and step back and look at the mountain.
Yeah, and it's interesting to me how quickly we go from that euphoric feeling to anxiety and fear. It doesn't take much.
Yeah, no, it doesn't.
And this week in the markets, it really hasn't been much when you step back and look at everything. I mean, over the last month, the market is still up 2% something. I don't remember the exact number, 1.5%, 2% in the S&P 500. The NASDAQ's up more than that. The Dow Jones is up over the last month. It's just we're looking at this tiny microcosm over the last week and a half, 2 weeks, and we're juxtaposing that emotion that we're feeling currently into being scared about, a bunch of other things. I talked to a client earlier this week that wanted to sell out of one of his accounts, totally sell out of one of his accounts. And I asked him, I was like, why is it that you want to sell out of the account? He said, well, the performance hasn't been that good. So immediately my antenna gets raised. I'm like, okay, I know that's not true. So I pulled up his account and I said, by the way, your performance is, okay, this is a performance. It hasn't been bad. Actually, the performance has been quite good in your account this year. What is it about your performance that, you think it's not doing well? And he said, well, I checked it last week and it looked like it had gone down. And I'm like, From when? the week before? Yeah. Because this week, and then I gave him the number, but it was in the double digits percentage-wise. I mean, his portfolio has done very well this year. We've done well. But he just got so caught up in the emotion. He's like, I think something big's coming, and I really just want to liquidate this account. I'm like, you kind of go back and forth with him, but there's not much you can do, right? But it's interesting because I know this specific client also has cash on the sidelines that they're not doing anything with. So
how many times have we said the riskiest investment there is cash?
It's cash, yeah, absolutely. And if all this cash that he was sitting on, if it was invested the same way that the accounts that we had here, he'd have a lot more money. Yeah. He'd have a lot more money. Just it is what it is. But it's just interesting that juxtaposition, or how quickly we go from the thrill and euphoria of good market returns to fear and anxiety about losing what we just gained. Even though we've not really it's just all on paper. All these gains are all on paper. Right. And especially when you're looking at it from the perspective of these are accounts that we don't need to touch. for for a long period of time.
So let me geek out and throw some numbers just for a second. Yeah. And this kind of harkens back, something that you just said a second ago, and it also harkens back to the stop looking at the yo-yo and back off where you can see the mountain climber, or better yet, where you can see the mountain. So you said, the markets are down this week. The NASDAQ's down 1.5. The Dow is down. Actually, the Dow is up, and the S&P's down, I think, half. But over the last 2 months, the S&P is up, over the last month, it's up 2%, right? So let's do some rudimentary math. If you take that 2% over the last month that we're still up, well, let's extrapolate that out over 12 months. So 2 times 12 is 24. So at that pace, even with this little downturn we've had, you're at a 24% growth rate at an annualized rate. What's the average return for the S&P 500? About 9.7, right? You're more than double. In fact, you're more than almost triple what the average is for the year. You're just paying the piper a little bit, right? The guy that you were talking about, just performance is bad, I got to get out. You're killing it. You're absolutely
he's doing fantastic. His account was doing really well.
And it goes back, if you're a long-term investor, you just said, I put some money in 3 weeks ago. That money's down, but you're not going to use this for 20 plus years. What should you do with money that you're going to be using 15, 20, 30 years from now? Nothing.
Well, though in fairness, that client won't. He's a much older client. He won't be around in 20 years. But his kids will be.
His kids will be. Yeah. But you just said he's sitting on cash. He's got the conservative side of his investment already. Yeah. So and I think that's where people have a tendency to look at their investment portfolio as a whole. The reason that we started running our business the way that we've done it is because people do this, and we don't think they should. Instead of looking at everything going, okay, well, I'm close to retirement, I ought to be pretty conservative now. No, you should be conservative on some of it. Yeah. But some of it, you're likely to use this 20, 30 years from now. Some of it, your kids are the ones who are going to, you're never going to spend this. I had a conversation with a client just this past week where he said, what should I do with this? Money just came out of an old annuity and I put it in there. How should we invest it? And I said, I really think we should be fairly conservative with this. Oh my gosh, why? Got a little bent with me. And I said, what is the likelihood that you're going to use this money in the next 5 years? And he said, well, about 20,000 of it for sure. And I said, why in the world? And he wanted to just do an S&P 500 fund. So why in the world would you put this in the S&P when you're going to use this money in 2 years, right? So I said, you're going to use $20,000, within the next couple of years. What about the rest of it? Well, that part, I'm unlikely to ever use it, right? This is going to be children and grandchildren's money. Okay. So why don't you take $20,000 and invest that in an appropriate way for something you're going to use in 2 years? The rest of it, now we can be much more aggressive with that. And that's kind of my point. We have a tendency to look at our entire portfolio and think it all should be invested a certain way instead of breaking it up because, different parts serve different time frames or purposes.
Well, it's interesting because if you're listening to this podcast and you've worked with advisors who aren't us, I'm going to go out on a limb and guess that you've probably taken some level of risk questionnaire in your life at some point. Those are all garbage. They're all garbage.
Absolutely.
Total hot garbage. The only reason you take a risk questionnaire is to cover the advisor who gave it to you, is to cover their butt. Yep. That's the only reason.
That is absolutely true.
And the way that those questionnaires work, or what they're designed to do, is basically allow the advisor to drop you into kind of a moderate, traditional 60-40 type of a portfolio,
or whatever. Yeah.
Because advisors do not get in trouble with a 60-40 portfolio by the auditors or the SEC. No advisor ever got audited by the SEC because they had too many clients in a moderate type of a portfolio with a certain amount of risk versus reward. Right? It's unreasonable, it's illogical, and it's dictated entirely by emotion, because those risk questionnaires, what they do is they ask you, well, how would you feel if the market were to drop 20%? There's not a person in this world that's going to say, I feel fantastic if my portfolio were to drop 20%. Right. No one would feel happy about that. But what those don't do a good job of is, okay, well, understanding why there's a 20% drop in the market on money that I don't need for 20 years, and understanding why that's not a big deal. Not to say that a 20% loss certainly it's a big deal, but why it shouldn't be when you factor in and zoom out and look at the history of the stock market, right? So that's why we don't do risk questionnaires. We have a very specific method for assigning risk in your portfolio based upon when you need access to that money. So if you think about every single dollar within your portfolio, we assign a risk based upon when you need access to that dollar. So if you need that dollar in the next 5 years, this is how it needs to be invested. If you need that dollar in 10 years, this is how it needs to be invested. If you need that dollar in 20 years, it needs to be invested a different way as well. Right? So figuring out very, very specifically when you need access to a dollar, because we talk a lot about purpose. And this is going to be a little bit of a foreshadowing, by the way, because we're going to be doing some episodes here in the new year as we move into our new office and after some rebranding stuff that we've been going through. But we talk a lot about the purpose of money. What is the purpose of money? Why do you have it? Why does it exist? And understanding, okay, let's look top down at your overall portfolio. What are you using this money for? If it's to spend, if the idea is to spend this money, then you invest it a certain way. Doesn't mean you invest it in the stock market per se, but you assign a certain level of risk for every single dollar in your portfolio based upon what it is designed to do for you. What the purpose of that dollar is will determine what type of risk it needs to be assessed. Okay, and that's how we look at every single dollar in your portfolio. I don't care if you have a $100,000 portfolio or a $10 million portfolio. The process is the same. Tell me what that dollar is designed to do for you, what it's designed or how it's designed to be spent and when, okay, or if it's designed to be spent at all, okay, and we will tell you how best to invest it. And because we take such a logical, almost mathematical viewpoint of risk within your portfolio, it eliminates this emotional cycle of investing that a lot of our clients go through. And by the way, we do this with our clients, and they still get emotional.
Of course they do.
They still get emotional. It is what it is, and I understand it because money is very, very emotional. But our job is to take that emotion to the best of our ability out of our process. Yeah. Because our process cannot be dictated by emotion. The way that you invest your portfolio cannot be dictated by the wild swings that you go through naturally as you embark on your investment journey throughout your lifetime.
I'm going to add something to what you were just saying. Yes, it's exactly the way the reason that we do it that way. But it's also the primary reason why we're not fans of do-it-yourself investing. And it's not because we love our jobs and we like to get paid. Obviously, those things are true. But the DIY investor, and I've had this conversation more times than I care to think about, you cannot invest your own money and not be emotional. It's absolutely impossible. I'm emotional with my own money, even though I handle the investments on it. I'm much better than the average person because this is what I do. But if you think for 1 second that you're the one who makes the sacrifices, you didn't spend the money on the fun toys when you were younger, you saved and you built up that nest egg. If you think that you can invest that without emotion, you're crazy. You're kidding yourself. And therein lies the problem. So if you get emotional and then you have news cycles like what we're in right now, and you don't take a step back and say, yeah, I'm down this week, this month, whatever, but look at where I am over a broader period of time. And what is the purpose of this money, right? The conversation that I had about this part should be conservative and this part should be aggressive based upon when you're going to use it, right? Too many people, they get wrapped up in the emotion, or then the other one, the goal, you were talking about the purpose of money. This is one that I personally will not accept. The purpose of money is to get bigger. That doesn't serve anything but ego, right? We actually had a comment. We were doing a podcast quite some time ago, and we were talking about taxes. And Annalise saw a comment that somebody had posted on social media about it, where the client didn't sell the inherited money, and now they've got this huge tax burden they wouldn't have had. And the comment was, but if they'd have sold it and they'd have bought something else, they would still have the tax burden. That's true, but that wasn't what they wanted to do with the money. They wanted to spend it. You know what I mean? So it comes back down to what is the purpose of the money. If the purpose is to live on in the immediate future, why are you invested in such a way that we've got those ups and downs? If the purpose of the money is literally to give to your grandchildren so that they can use for their retirement or whatever the case might be, you should be aggressive. And by the way, these little blips in the market, or even the big downturns and the corrections and the recessions, you say it all the time, that's not a glitch. That's a feature of the market. Take a step back and look at it from a bigger point of view and get those emotions out, and you'll be a whole lot happier.
You don't get the reward without the risk. And you have to realize the risk in order to get the reward. And I always say, because there's so many people, and I hear this in real estate a lot, and I'm not dogging real estate. We can do that in another episode. But so many people in real estate are like, this is why you can't trust the stock market. It's like the casino. That's why you invest in property, because the value never goes down. That's crap. It's total crap. Because if you could assign a value of a house, if you could sell your house every single day, every single business day that the market was open, if you could sell your house would not sell for the same amount of money every single day. You just don't sell your house every single day. So you're not aware of the ups and downs of whatever someone else on the open market might go look to buy your house for. There's no way to structurally understand the value of a house on every single day. You only have 2 price points when you buy a house: the day you buy and the day that you sell. Okay? Unfortunately, fortunately, or unfortunately, depending upon your viewpoint, but when you're looking at stock market investments, you understand every single day structurally what the value of your investments are. You see the good days and you see the bad days. I can guarantee that there's probably a day, if I was going to go to put my house on the market, if I had sold it over the summer, I probably would have got a higher price than I would if I tried to sell it today.
I love that example. That's what I was just thinking. There's somebody out there listening right now going, that's not true with real estate. Yeah, it is, and there's the proof. Yeah. Why do you sell your house in the spring or the summer? Because there's more people out there shopping, and you're more likely to get a higher price than you would in the fall or the winter. And in some parts of town, like I'm thinking, from our partner when he was selling his house, I believe it was last year, in Oldham County, where people are moving to Oldham County because of school situation, you list your house in the fall after school has started, you'll get a substantial amount less than what you would get if you sold it in the spring where people get moved in before school starts. So to your point, real estate moves up and down too. You just don't see it because you don't sell real estate every single day. Yeah. It's a single transaction kind of thing.
So, I mean, that's why so many people get attached to their houses, because they think their houses have gone up so much in value, but they don't see the daily fluctuations because structurally there's no way to see that or understand that. Another thing that I think is happening too that's unique about this week, because we've had days like this over the last 6 months, and the market's been ripping, and it hasn't caused the level of anxiety that I'm seeing now. And I don't know why, but I have a guess as to why. What we're seeing right now, so what have we just got done kind of wrapping up? A midterm election that got a lot of press.
Well, it was an off-year election.
It was an off-year. Well, I'm sorry. That's right. It wasn't a mid. You're correct. It was an off-year election. But, any kind of election.
You had elections in what, 4 states?
Something like that. But it's always so funny. Those off-year elections have such an outsized influence. We see it in Kentucky because our governor's race.
We have an off-year election.
Is an off-year. It's an off-year election. So our governor. It's always funny watching these national prognosticators make some big deal over our governor's race. It's only because we're the only governor's race going on that year. Anyway, but we just got done with some off-year elections at the same time that we just got done with the government shutdown, right? At the same time that we are just at peak AI bubble commentary, at the same time that we're at all-time stock market highs. So there's just a lot of prognostication that's occurring right now, a lot of commentary that's occurring around markets and business and the economy in general. And I say the economy in general, I'm relating to discussions from all of these politicians around the economy and, of course, how the government shutdown affects the economy and all these different things. You're just hearing a lot of noise, basically. Because like I said, structurally, nothing has really happened in the markets to justify the drop that we've had.
Right.
And so I'm not saying that that's good, bad, or it is what it is. But structurally, nothing has collapsed. Nothing has happened. Except I think we've just been inundated over the last couple of weeks through the government shutdown and the elections and all the other stuff going on with the AI stuff. We've just been inundated with news. And this goes back to one of my core philosophies that I've embraced as someone who teaches about this stuff and someone who talks about this stuff and works with clients and we manage money. Stop getting your economic news from political news sources, because I cannot figure out any other reason recently to justify why people are starting to get a little bit more anxious and fearful about what's happening in the markets, other than the news commentary, has been ramped up to a 10 over the last several weeks. To me, that is the only thing that I can figure out that's different recently that justifies what's going on.
By the way, virtually all news sources are political. It's just the nature of what they are.
Not
right?
virtually.
Yeah, okay.
Yes.
All right, let me rephrase. All news sources are political. So that's the stop watching the news.
I'm not saying stop watching, but understand what you're watching when you hear it. Right?
Okay, you know this. I have a TV in my office. That's my background noise while I'm working. I pay attention to it. I love it. God help me, I'm a news junkie. But I also understand how to filter out the political aspect from the true financial aspect, right? Mm-hmm. I don't think most people can do that. And even I'm guilty of getting stuck in it from time to time. Stop doing that, and you'll live a happier life. My wife...
I'm talking to left and right, by the way.
Yes, absolutely. Yeah. My wife has made it a point to stop watching the news. She said, if something's important, you'll tell me because I know you can't help yourself. Mm-hmm. All right, that's fair. She has, quite a few friends, family, things like that, who are of a political bent that is not in line with hers. Polar opposite types. She blocks them on Facebook and Instagram and all that. And for the most part, she stays away from social media. And you know what? Her life got better. Mm-hmm. It actually improved. She is a much happier person than what she was when she was inundated with that stuff all the time. Best thing that you can do to control the emotional side is to turn off the noise, as you phrased it. You'll just be much, much happier. So let's stop.
Yes.
I want to get your opinion now that you've tasted it. And we have had to do more than one take this morning due to some technical difficulties.
I've not poured a second.
But you've had an opportunity to kind of take the first taste several times.
I really wanted to pour a second one, though. And I might when we get done filming.
What are you thinking?
This is good. So I'm not really someone who necessarily is going to come on here and give you my flavor profile. Right?
We're working on that.
You're going to love this, though. Peanut butter and caramel.
Wow.
That's what I'm getting.
Wow.
And I don't know if I've ever said peanut butter on here once.
I don't think you have.
I don't believe I have.
He's learning, ladies and gentlemen.
It's smooth, one. It's really, really smooth.
Yep.
But there's a ton of flavors. Was it 100 proof?
It's 100 proof, and it's not age stated. I don't believe
No, it's 10. It's in here.
Oh, I'm sorry. Yes, it's a 10-year-old.
So it's a ton of flavor.
Yeah.
There's a pretty good flavor profile for 100 proof. Not strong. Mm-hmm. I mean, it's easy down the hatch, but there's a really good profile there. And I don't know. It was confusing me for a minute. I was trying to figure out what I felt like I tasted because I knew I was tasting something, but I kept coming back. I think it was like kind of a little bit of a peanut butter flavor.
Now, see, it's interesting. First of all, I think it's awesome that you're starting to pick up some of those flavors. So your palate is just developing. I think all of us go through that. I certainly did too. I did not taste peanut butter. I did get some cherry, maybe a slight hint of citrus. Maybe that's in my head. I don't know. When I put a couple of drops of water in it, I lost any hint of citrus, and most of the cherry is just all caramel, very pleasant. Mm-hmm. Now I want to try it again with that peanut butter in my head and see if I pick up any of that, because I think that would be good. Not to say that peanut butter whiskey is good. They do make such a thing.
I've had it.
You've probably seen it.
I'm
gonna say I've tried it. I'll never try it again.
I mean, it's bad. Well, those flavored whiskeys, they're not bourbon. First of all, they're flavored whiskeys. So that's a different thing, right? You can enjoy them when you understand what they are, right?
But I'm looking forward now to see if I can pick up a little bit of that peanut butter in there. Because that probably would be very, very pleasant.
It's interesting because of the flavor. Like you take a drink and you almost want to chew. Like there's just a lot of flavor to it.
Yeah.
It's a great pour.
I wish that this was not a limited release every year.
Yeah.
I wish that they would just pump this out, and maybe as the bourbon market slows down, but the supply is already there because this is a product that takes years to get to market. Maybe this will be a more regular produced. I would, if the price was right, this would be, and we were joking about this beforehand, the daily drinker phrase.
Yeah.
Anything that is an actual daily drinker is probably not a good thing.
But you shouldn't be daily drinking
right,
anyway, so let's start there.
I know what you mean by that, and I think you're right. This is one of those that, if the price were reasonable, this is something that if you could only have one bourbon ever again, this one is one you wouldn't be upset if you picked it.
Yeah, I mean, this was, if I'm going to splurge, like I said, I don't buy very many 80. Every now and then I'll splurge and get something a little more expensive, but you said this was in the $80 retail,
that's right,
at least when they first release it.
Yeah.
I would 100% splurge on this.
Yeah.
This is.
Oh, really?
I mean, not a lot.
Well,
right?
you're not going to go out and buy 10 bottles, understood.
Yeah, but occasionally if I'm going to splurge, if I've got people coming over or something, right? But this is a really good bottle.
Yeah.
I'm a fan.
And
I love all the old faux stuff, right?
We were talking about that beforehand as well when I brought in the options for you to pick from today. There are several major distilleries out there, and they all produce multiple types of things. But if you were boxed in and you could only pick from one particular distillery for the rest of your life, I think the average drinker out there would probably go for Buffalo Trace.
Which is the easy.
Right. It's an easy one. They have so many fantastic products. The products that they have that are not fantastic are not designed for discerning bourbon drinkers. It's the Fireballs of the world and stuff like that. Yes, that's their biggest seller, right?
And I would love to tell you I don't have a bottle of Fireball at my house, but
I do not have a bottle of Fireball.
My wife has discovered apple cider and Fireball, right? So cinnamon and apple cider.
I have this weird feeling that my wife will listen to this and she will go, ooh, that sounds good, because she loves apple cider. So, if a bottle of Fireball shows up at my house, I'll know why.
I'm not going to lie. It's not bad. Yeah.
But that being said, if I had to pick a distiller where I like their product line top to bottom, it would be hard for me to pick against Old Forester, because I don't remember having anything that I didn't like. It's all really good stuff, and I like the flavor profiles that they come up with. So I don't know. I've kind of got my stuff in my bar downstairs by distillery. This shelf is this, and then so on and so forth. I think I have more Old Forester than anything else.
Yeah.
And there's a reason for that. So.
Well, the 1870 Whiskey Row series is kind of my go-to now. That kind of rotates, but right now it's at 1870. So I will pretty much right now always have a bottle of that. And I'll usually have 2 or 3 at least others. I'm due to stock up. I'm hosting Thanksgiving, so I'll have to go get a couple bottles for people coming over.
It depends on who you're hosting Thanksgiving for. If you're hosting Thanksgiving, for
whether or not I like them,
who will bring a $5 bottle of bourbon and then they will immediately start drinking your good stuff.
Yeah.
Make sure you hide the good stuff.
Yeah. Well,
but if they bring a good bottle and then they start taking whatever you allow, get out the good stuff for them, because they get it.
Well, luckily I'm hosting people I like, so I'm happy to go buy something decent. So. But usually I'll have like a bottle of Makers and maybe a couple other halfway decent,
hard to miss with Makers.
Halfway decent bottles. So, but anyway, probably a good place to wrap up.
Yep.
This is a good episode, good conversation. We come back to the emotional cycle of investing, because it's so interesting how people feel like they logically they know. Everybody knows the name of the game is long-term investing, yet they still get stuck in these emotional traps from time to time based upon what they're seeing in the news, based upon what they're seeing in the stock market, and at the end of the day, based upon what they're seeing with their investments as they might potentially go down in value, for a few days. Maybe even a few weeks, right? It is what it is. But it's always good to throw these reminders out, and that's why we talk so much around the emotions of investing, because you need to be aware of the emotions. Doesn't mean they go away, but as long as you're aware of what you're feeling and you know why you're feeling it, and you know that maybe you probably should maintain that long-term view of your investments, of your portfolio, that's going to help you get through some of these weeks like we've had, like this week.
Amen.
So that's why we talk about it, and that's why we
watching the news.
Yep.
if you want to be happier.
Goes back to the old joke, the Vanguard. I don't know. I don't even know where this joke happened, but it happened. There was somebody talking about a Vanguard portfolio, and Vanguard put out a study, and it's not a real study, by the way, but it was a joke saying that Vanguard, they put out a study around the best investors on all of their platform were the dead people. because they weren't going in and making trades on their accounts. The ones that were going in trying to make trades and time the market, those were the ones that were not doing as well. So,
amen.
Same thing here. All that being said, thank you for joining us. Thank you for enjoying the 1924 Whiskey Row series with us. I just poured me a little bit more because my meetings are done for the day. And yeah, we'll see you next time.